AI is changing the world around us in greater and greater ways, from self-driving cars to content recommendations to shipping optimization. But now it has entered a new area, banking, through a company called Upstart. Now, what's Upstart, you may ask? Nothing. What's up with you? Okay, joking aside, Upstart is a new AI lending platform that does away with the old credit score model of matching borrowers to loans, instead using a sophisticated series of AI models to predict whether or not someone will default on a loan. They incorporate thousands of data points to a process which in the past just relied on a single number. And their approach has seen a huge amount of success, with the company growing over 1,000% this year by discovering previously completely overlooked areas to provide personal loans. But they're not done. Auto loans, mortgages, student loan borrowing. AI could generate models so much more efficient than traditional banks that the entire lending industry could become obsolete in a matter of years. Hey everyone, and welcome to FinTech. In this video, I'm going to be reviewing Upstart, going over their background as a company, talking about what they actually do, and looking at their latest earnings numbers to see how they have been able to literally 10 times their earnings in the last 12 months. Finally, I'll offer my thoughts on their future and let you know whether or not I personally am investing in the company. And by the way, to make this video, I read through Upstart's entire earnings call transcript and presentation, and it was not short. So if you appreciate that kind of effort, please just hit the like button, and let's first dive into Upstart's background as a company. Upstart was founded in 2012 by a team with some pretty notable names on their resumes. There was David Gerard, a former vice president of enterprise at Google, and Paul Gu, another Googler who was also a Thiel fellow. They spent 2 years building the company before pivoting in 2014 to their current line of business offering personal loans. They started out by developing statistical models of borrowers using factors like their job, their GPA, or their credit history, but these initial statistical rules-based models eventually gave way to more advanced AI models. They IPO'd relatively recently at the end of 2020 at a price of $26 per share. In the 8 months between then and when I'm recording this video, the stock price has 8x to over $200 per share, giving them a current market cap of over $16 billion. And just in the past month, the stock price has risen over 80%. But that rise in the stock price all comes back to the product which Upstart creates, which is essentially a better way of measuring risk through AI. Now, AI is a huge buzzword right now, and it can mean a lot of different things. So let's be clear about what it means in this case. Upstart's AI models are essentially advanced pattern matching. The same way I could feed in thousands of pictures of a cat into an AI model to train it to recognize cats, Upstart feeds in thousands of data points to determine whether or not a borrower will default on their loan. This means that as time goes on and more types of data as well as data points are fed in, the better the AI can get at predicting whether or not someone is likely to default. This also gives Upstart a secondary advantage where as they grow and start to make more loans, they become less and less reliant on existing loan data and are able to build a flywheel effect where offering more loans generates more data. And more data means they can more confidently offer more loans. Upstart has over 10.7 million data points with over 17 billion cells of data in their training set, more than double what they had 1.5 years ago. And Upstart's technology also makes the process of signing up for a loan much more automated, since no human needs to be involved in the approval. Currently, 71% of borrowers are instantly and automatically approved for a loan without any need for human intervention, giving Upstart much less overhead than a traditional bank. But an algorithm by itself does not generate money without the business around it. So Upstart makes money in 3 ways. The first way is through paid referrals. When someone goes to Upstart's website looking for a loan, Upstart will evaluate that person's risk, make them a loan offer, and then use capital from a traditional bank or investors to fund that loan. In return, the bank provides a fee to Upstart. The second is from banks using Upstart's platform. Upstart allows banks to take their loan tool and rebrand it for their own website to let borrowers find loans directly in the bank ecosystem. And they pay Upstart for this as well. Finally, for a loan that Upstart farms out to a bank, they also receive an annual fee for any loan that that bank is now servicing. And don't worry that Upstart's future is pegged too closely to the health of these loans. This quarter, more than 97% of their revenue came in from fees from banks or loan servicing, with zero credit exposure or demands on their balance sheet. But while it is nice that Upstart has these 3 streams of revenue, they are all essentially tied back to Upstart's algorithm. As long as that algorithm makes lower risk, easier to obtain loans than anyone else, they will keep making money. The advantage to this is it's a naturally high margin business, and the key to both growth and profitability is to simply make more loans. So since we're focusing on growth here, what we really wanted to see from Upstart's latest Q2 earnings is rapidly increasing revenue. And boy, did we get it. Upstart grew its revenue 1,018% year over year. That's not a typo. They made 10 times the revenue this quarter that they did in Q2 2020. But in their earnings call, the CFO said that this wasn't really a useful number to look at because 1 year ago, the company was facing massive headwinds from the pandemic and was barely even offering loans. So ignoring the year-over-year comparisons, let's instead compare them to how they did 2 years ago and last quarter. So compared to 2 years ago, the company's revenue is up 5x from where it was then at $194 million this quarter. This is also an increase of 60% in just the last 3 months. Looking at their contribution profit, which is basically their revenue minus variable costs from acquiring borrowers, it was up 73% quarter over quarter to $97 million. So despite growing incredibly quickly this quarter, they did so while actually improving their overall profit margin, which is incredibly impressive. But while you might think that growth is due to the positive macro effects in the economy right now, the CEO called out on the call that the personal loan market has actually been shrinking for the past 18 months, meaning that Upstart's growth has been while it is facing macro headwinds from the credit markets. Their transaction loan volume hit $2.8 billion this quarter, up 4.75 times from where they were 2 years ago, and up 61% in just the past 3 months. They did say on the call that some of this growth was from increased marketing, which they spent an extra 50% on this quarter, but the rest of that growth came from an increased conversion rate in their sales funnel. So right now, 24% of people who inquire about a loan end up signing up with Upstart. That's up from 22% last quarter and 17% the quarter before that. That means that not only are they actually reaching more total potential borrowers, but their improvements to their models, reducing friction on their website, all of these changes are making it so that more and more people sign up for a loan once they start the process. The CEO said on the call that going forward, they expect around 50% of their growth to be from increased marketing to reach more people, and the other 50% will come from improving their conversion rate even more. They now have 25 separate banking partners on the Upstart platform, and they have a robust and growing list of lenders in our pipeline for the second half of 2021. This is good because, remember, more partners equals more loans, which equals more money for Upstart. While they are growing their marketing spend, they are also aggressively investing into their technology. Investment in engineering and R&D grew 66% quarter over quarter to $31 million in Q2. They mentioned how in one case, they eliminated a lingering rules-based constraint on their model that limited only certain sized loans to be approved. But with more powerful algorithms and growth in training data, their models can now handle that issue natively with more precision than following a hard set rule, boosting their overall approval rates. One other extremely important note, for the first time, one of their bank partners decided to completely eliminate any form of FICO score requirement when using Upstart. Basically, the bank said, "We trust Upstart's technology to take out the last guardrail that we had and rely entirely on their AI model." This demonstrates a lot of confidence in the company from their partners, and I would not be surprised to see more banks quickly follow suit once they realize that they are missing a whole segment of the loan market. But speaking of loan segments, right now Upstart estimates the total addressable market for personal loans, the type of loans that they offer, is $85 billion. But they estimate that the auto lending market is $635 billion, and the entire lending space at $4.2 trillion in just the US. Which kind of shows us where Upstart plans to move next. Upstart's next priority, aside from improving their existing models, is to move into the auto lending space. While this space is substantially different from personal loans in that it involves a physical asset that secures the loan, Upstart is confident that their AI-based approach can yield huge efficiencies in this market as well. They acquired the Prodigy software platform earlier this year, which is a car buying and lending platform, which they describe as kind of like Shopify for cars. They've started to ramp up auto lending using this platform as their foot in the door. In January, they offered their auto refinance product in just one state. Then they expanded into 14 states by the end of Q1, and now they have expanded to 47 states, covering more than 95% of the US population. They are also investing heavily into the auto area, expanding their dealership footprint by 24% in the last 3 months, and putting money back into the Prodigy software platform. While we haven't yet seen Upstart start to actually offer AI-powered loans through Prodigy online, they expect the first Upstart-powered loan to be offered before the end of 2021, and then it'll be off to the races. So with some of their future plan in mind, let's take a look at the company's forecast for next quarter. They're expecting their revenue for Q3 2021 to be between $205 and $215 million, representing a year-over-year growth rate of 221% at the midpoint. But that growth rate is a little misleading since they already grew so much in their last quarter, so a better measure would be sequentially or their quarter-over-quarter growth rate, which comes out to between 5 and 10% quarter-over-quarter. Now, if they hit that growth rate every quarter for 4 consecutive quarters, it would put them at a yearly growth rate of around 21 to 46% year-over-year. Good, but not remotely close to what they just reported. Granted, they will probably beat that growth rate by a substantial amount, but I'm not familiar enough with this company to say how much they're likely to beat their estimates by at this point. They expect their contribution margin to stay around 45%, and for the full year of 2021, they forecast revenues of $750 million, up from the $600 million that they expected last quarter. Again, good, but not as much of a blowout as their current quarter. So at face value, these forecasts don't inspire too much confidence. Is this company really twice as valuable after reporting just 1 quarter of increased growth? Well, I think there are a few factors here that we need to consider to go along with the raw numbers in this case. The first is one that I've already alluded to, which is auto lending. Their auto lending platform clearly is not yet fully ramped up in the same way that their personal loans are. But they are adding 24% more dealerships quarter over quarter and investing heavily into the Prodigy software platform. So while this growth really won't help them too much in 2021, it will likely be a huge driver for them in the longer term, especially given the size of this market is nearly 8 times larger than the personal loan market. The other thing that we need to consider is that their forecast for earnings over the next few quarters has a pretty big assumption built in that was called out by an analyst during the earnings call. You see, leadership is assuming that the macro credit market will be relatively static from one quarter to another. So any growth they see will come directly from their own improved products or marketing. But like I mentioned earlier, we've seen Upstart's growth for the past year and a half amid some pretty major headwinds in the personal loan market. That means that if those headwinds were to subside, the forecast would likely underestimate the company's actual performance. Now, I can't predict where the credit market will go, but it's good to know that that assumption is there. Because if we start to see the market start to improve, we might be able to predict an earnings beat from Upstart before they actually report earnings. So while Upstart won't keep growing at the headline 1,000% year over year, they are still growing well, and more importantly, they're continuing to invest in improving their core product and in expanding into new markets. Going forward, we will want to see them start to offer loans through the Prodigy software platform, and ideally see the same kind of success with auto loans that they saw with personal loans. We'll also hopefully see the macro credit market for personal loans start to clear up a little bit. As for me personally, I have invested in Upstart. In fact, I've bought into them in 3 separate batches. The first was probably around a month ago where I bought in some shares at $110 a share. Then shortly after they reported earnings, I bought some more at $178 a share. And then just before filming this video, I also bought in a little more at $213 a share. Overall, I'm now happy with my allocation in the company, which puts it just outside my top 3 largest positions. But let me know what you think of Upstart. Don't forget to like and subscribe, and I'll see you next time.